Welcome back to the Infinite Banking with series. Today we're going to be talking about Foresters. And so we're going to be talking about the company. We're going to look at the ratings. We're going to look at how they do loans, how their paid up additions work, the pros, the cons, their illustrations. They're also not a mutual company. We're going to close that loop here soon. We're also going to talk about an agent perspective. And as always, Alden, you've done a phenomenal job in this series and very much look forward to diving into Foresters in this Infinite Banking series that we've been doing on all the major insurance companies that people use for whole life infinite banking.
Absolutely. Well, Caleb, thank you for the intro. Yeah, the Independent Order of Foresters. It makes it sound like it's out of Dungeons and Dragons. It's just a cool name. So Foresters, it's a little interesting. So as we dive in here, I think we're going to learn some pretty cool stuff about another way to do overfunded life insurance with not a mutual insurance company. So Foresters was founded in 1874. And so they have that rich history of being around for over 150 years, paying what I'll call services, benefits, bonuses to their clients. Now, notice I didn't say dividends. They've only been paying dividends for about 60 years. Now, the interesting thing about Foresters is they are not a mutual insurance company. They are mutual-like. They are classified as a fraternal benefit society. Very interesting. One of the other carriers that we reviewed started off as a fraternal benefit society and merged, or I should say restructured into a mutual insurance company. Foresters has been a fraternal benefit society since 1874. Now, what does that mean? Well, the dividends, because you own a participating whole life insurance policy with a mutual company. That's what we're trained. That's what we understand. Foresters offers a participating whole life insurance policy to its certificate holders. It's not technically a policy contract. It's a certificate in your membership into the Fraternal Benefit Society. I had to learn a whole bunch of new terms when I was doing the research. It's very interesting. But in the reality, it plays out the exact same way. It's just a different code in the insurance market. Still a very good life insurance company. They span across actually 3 different countries, the US, Canada, and the UK. And they have that strong history of over 150 years sharing profits. In recent history, it's dividends. In the longer history, it's different benefits that will go over for their specific members and their certificate holders. So rolling into the financial strength and performance. Now, the 2026 dividend dollar amount, it was not declared. The most recent one I could find was back in 2024 for about $26 million in the US market. Now remember, separate companies, because they've got a Canadian base, they got a UK base, but they all go back up to the Order of Foresters in that benefit society. Very interesting structure. Now, for their company size, that dividend is fairly healthy. But the other thing we have to remember is they're paying other benefits, which we're going to review. The value of those benefits is over $15 million on average for the last several years. So that's another give back to the policy owners, the certificate holders for this particular company. They do declare their dividend interest rate. That's a healthy 6%, fairly competitive in the marketplace, on track with some of even the bigger mutuals. And their average lapse ratio, I tried so hard to find this number, and I had to extrapolate. It was infuriating. I think because of how they're structured, they're not the traditional insurance market. All the software that I use to vet these insurance companies, they don't even know who Foresters is. So it's kind of outside the norm. But using Gemini and some extrapolation, we say, cool, we'll say it's about average based on some of the last annual reports.
So if AI has ever lied to you, don't hold us hostage by that assumption. But it is interesting. I think one person's, cooking up in their brain, oh, maybe starting a fraternal company is a loophole here. Like, I like this. So.
As how the company stacks against the competition, we have direct, we have non-direct. Foresters is a non-direct recognition loan company. And their ratings are interesting. Again, because of how they're structured, not all the same agencies apply. COMDEX score, they don't have one. AM Best, thankfully they do. So they are an excellent rating with AM Best. That's the 3rd level down from the top. And then they also have a Morningstar rating of A, which is really addressing the financial stability of the company. So overall, they seem to be in a good place. I don't know what their equivalent COMDEX would be. I would imagine based on their size and their assets and their portfolio, it's probably mid-80s. But I'm extrapolating at this point.
Yeah, because even if we look at, we just did Pan America before, they had an AM Best at A, and their COMDEX score is 78. Again, that's not saying anything about anything. It's just saying, like, it would be nice to see their COMDEX score. The fact that they have some ratings, I do know of some fraternal companies that don't have any ratings. They just show you, like, their balance sheet and all. And so I think it's cool that they have some ratings. It would be awesome if they were more like they spent more time in this department, but it is interesting to see that they have Morningstar. Is that the first time you mentioned Morningstar in the series?
It is, because all the other companies I looked at have AM Best and the COMDEX. So I picked
Yep.
two, and then I've had to jockey around and find others as we get smaller in the company list.
Yeah. Thank you for pulling that up.
Absolutely. Foresters, as I mentioned, far-reaching. So the UK, Canada, and in the US. I will mention that it's not all one company, it's separate subsidiaries. So the investment profile, for example, in the UK is extremely different. When I analyzed their numbers at first by accident, they have over 50% of their portfolio in equities. Now, the US-based company that does life insurance is less than 10%. There's a huge difference, especially when you're thinking about mortality costs and everything else. So I don't know what they're doing in the UK, but jolly good show. I can say that because my grandma's British. All right, so as far as how they relate to IBC, all right, so they are actually pretty well known in the IBC space. There was a misconception that I first had when I started doing IBC work that Nelson Nash himself worked for Foresters. That's not the case. He was a Forester, which is a different different statement. So I used to think Foresters was like this company that Nelson worked with. Anyway, so it's a whole thing. I hope somebody else out there did what I did. But
I think you might be alone on this. It'll be interesting to see if anyone bails you out in the comments, because I definitely never had that reading the book.
Cool. I love that for me. That's great. So they are well known for IBC, and they are supportive in some ways. The reason I say this is that internally, their teams are familiar with it. They talk about it. A lot of their producers are IBC practitioners, but they choose to stance similar to Emeritus and Lafayette Life, where they're not openly saying like, hey, we support IBC. So more of the, what I'll call politically safe way to play the IBC game. Now, the whole life product that we're going to be looking at today is the Advantage Plus 2. And we're going to pull up some numbers from the cash flow perspective as well as the front load. So Caleb, as a reminder, if you want to just jump in here and divide both of those.
Yeah, cash flow is representing every year you're putting in an equal amount. And then the front load, we're showing in this series, front loading with $100,000 one time, and then you're paying less ongoing. And it just represents someone that's maybe sitting on more money. Just as a disclaimer, just because we're showing $50,000 ongoing in the front load doesn't mean you have to put $50,000. We just wanted to be consistent in this entire series. And so that's what we chose to do. But you can scale it down. You can also scale it up.
Yeah, absolutely. So first things first, let's look at the high level. Because the product is fairly simple, we have an early cash value in either the cash flow or the front load design between 85 and 94%. It's actually very strong in the early front load. This is industry leading high is what we're looking at. And we'll see a comparison when we do the final video as well. Both of the products, they're really designed to be paid long term. Once the term falls off, they're still very efficient to accept continual premium into that whole life insurance contract. Now, one thing I will say is that they do actually project much lower than I had anticipated. Seeing a very high cash value in the very first year, that was great. But then the long-term performance was lagging severely. So we were looking at an IRR, or internal rate of return, around 3.2 to a 3.8, given the current dividend projections, depending upon health and age. Diving in here to the Forester's certificate. So it's not a policy contract, it's a certificate. We are going to be looking at that cash flow design at $50,000 a year for 20 years, and then running the same assumptions as before. We are doing an offset. Now, something that kind of freaked me out when I first saw it is that this, it's not a dollar sign. That's not a dollar sign either, because the home office for this insurance company is based in Canada. So even though they sell US-based products, they're a US regulatory compliant body, their illustrations can be a little bit confusing because at the very top, you'll see Toronto right on there. So don't freak out. It's normal for this insurance company.
It is kind of weird, though, that they don't have dollar signs if they're literally portraying a US-based illustration, because this illustration is not being used in Canada or Europe. So that is kind of unique that they do that.
Yeah, I don't know. Maybe they sent me the wrong one. Somebody correct me in the comments if they've seen one with a dollar sign, but we'll go with this one because that's what they sent me. $50,000 a year. First year premium goes in, end of year value is looking to be almost, we'll call it $46,500. So from a percent perspective, that's around 93% in the cash value in the very first year. Death benefit is also fairly healthy, just above $1 million, about 1.3 million. Now, we've been talking on the channel about a couple of different points that I like to look at when we're looking at the policy for efficiency's sake. The first is break even, and the second is a capitalization point. So break even, quick definition as it sounds, when do I have more money in it than I put into it? That happens right here in year 4. So we put in $200,000 by year 4. Now we have a projected $200,000 and some change. So the second metric that I track is actually going to be the capitalization point. And so that point just says, if I would have put in $50,000 in that year, will I have more than $50,000 of increase? So when we look at the cash value numbers between years 1 and 2, we're just shy of a capitalization point. It happens right here between years 2 and 3. So with a capitalization point of year 3, we've now, what we like to say is overcome the cost of insurance, and now it becomes a souped up savings machine on steroids with tax benefits, which is kind of why we build these policies the way that we do. As we scroll down into the projections here, we are looking at a projected cash value of about 1.42 million after 20 years of funding, and a death benefit of about 4.2 as well. After that 20th year, the premium is offset, policy is paying for itself, and the benefits continue to grow on the cash value side. So front loads with Foresters, again, very strong in the early cash value. We're looking at around that 93% mark. So as first year, we're putting in 100,000, get a dividend paid at the end of the year, and then we have that 93,000 and some change cash value. If we compare this to the cash value policy we just looked at, the cash flow design, we've doubled the death benefit, right? If we're going to put in double the premium, we need to get the death benefit at least double to justify it to the IRS, because this is a U.S. regulatory product, even though it says it's from Canada, which is a little bit weird, that it's not a mech, and then we want to make sure we don't do that. So doubling that death benefit, and then we start to look out for when this policy breaks even. So from a break-even perspective, we're looking at right here in year 5. So we've put in at this point $300,000, we have just over. If we want to be super nitpicky, technically they didn't break even in year 4, but they were super close to doing it. So it's slight dividend fluctuation. You may have a year 4 break even as well. From a capitalization point, it's still right there in year 3. So the jump between year 2 and year 3 in the cash value is greater than the premium that you paid of $50,000. So we have that larger capitalization point happening there in year 3. We have more cash in it than we put into it in that year. The same design we've been rolling with this whole time, going out to 20 years, and then we stop funding. On the right-hand side here, we have a projected 1.5 roughly cash value, and then the death benefit is going to be that 5.4 or $5.5 million number as well. Now that you've seen some of the illustrations, you've seen how the numbers work in the way that we're planning to play these policies, how do you get access to your cash value? Well, similar to the last 2 companies we reviewed, Security Mutual and Pan American, Foresters has developed a very fast loan initiation. So loans available as soon as 10 days after funding. Now, one of the things I actually was told, as soon as you can prove the check cleared and show a bank statement or show a screenshot of your bank account, they'll honor and initiate a loan. So that could be pretty darn fast if you want to use it for that purpose. They are non-direct recognition, variable rate system, very similar to most of the companies we have looked at. They do allow portal access for loans. So you can call the carrier, you can go through your agent, or you can go directly through the portal for a paperless application. I don't have a policy, so I don't know what that means, but it's a paperless application for a loan, and they may request additional verification based on the loan amount, but they didn't have any hard, fast rules on that. Loan repayments can also happen through the client portal, as well as in the client portal, you'll be able to see the daily accrual of your interest rate. So this is the, in our terms, preferred method. It's the easiest way to see the interest you're being charged. It comes out on a daily basis based on the annualized interest rate of your outstanding balance.
Hey, I'm interrupting this video briefly to say, if you're serious about using whole life insurance for infinite banking, we have a free gift for you. It's called the IBC Company Guidebook, and it gives you inside access to the data behind these videos. Things like life insurance company COMDEX scores, their dividend performance, how they approach infinite banking style policy designs. It's all the information we cover in these videos organized in one place for easy reference. To access the guidebook, click the link in the description or pinned comment. Now let's get back to the video.
All right, so PUA flexibility. This is one of my favorite slides. I like comparing this across carriers, and as Caleb said before, it's probably something people need to start talking more about for their clients. Paid up additions flexibility across the industry varies greatly, but I saw something for the first time with this carrier I haven't seen anywhere else. So if anybody knows of this particular provision, let me know. They have a catch-up provision. Now, it is limited, like a lot of the carriers we work with, and this one is limited to $25,000. But they don't allow you to just catch up last year. You could be 9 years into the contract and catch up premium that you missed from year 2. They have a 10-year time frame from issue to the end of the 10th year where you can catch up premiums. Now, the caveat is that they do readjust the ceiling of your PUA rider at year 5 based on the average, and then on year 10 based on the average of what you've paid into that rider. So a brief example of how that works, Let's say you've got a policy that allows you to do $10,000 every year. Life happens the second year. You put in $50 to the PUA rider, and then a couple of years later in year 5, you're like, you know what? I had a great commission month. I got a bonus at work. I'm going to repay what I didn't pay 3 years ago. And I'll allow you to do that up to the maximum. That'll also save your average. So now that you've refilled bucket in year number 2, and you've been paying up to the max for the first 5, your 5-year average is now back on track, so you can keep funding at that same level. Very unique rider. I've not seen anything like that in the industry.
Also, that it seems like their minimum premium is lower than the 100 or 120 that a lot of companies have as a minimum.
Yeah, it's interesting. I've seen 50, 100, 120, and 300. I mean, pick a number. It's kind of interesting. The thing to understand too is that your policy is going to have a minimum and maximum, right? All the whole life products that we sell are going to have a minimum premium as a whole and then a maximum premium as a whole. Some of the carriers limit the amount of PUA you can put in to a dollar figure. This is like Pan American and Security. This is the same with Foresters, but their upper limit is fairly high. So it's about $300,000 of maximum annual premium into this specific rider. So large range there from a funding perspective. So they do also have anytime payments. You can make a payment at any point during the policy year up to the max for your underwritten policy. And then that payment reset provision as we walk through. 5th year, they look back to see your average, set your new PUA ceiling based on that average, and they do the same thing at year 10. The other carrier that does something like this is Lafayette Life, and they do it at year 7. So kind of right in between 5 and 10, they do a look back to see what your average has been. All right, so this slide is long. There's a lot here. This is where Foresters stands out from every other company that we have reviewed or perhaps will review, because I don't know of any other companies that are structured like this at this point. So somebody please educate me in the comments. Fraternal benefit members. So if you are a certificate holder, a member with this company, Foresters, you have access to a lot. I'm going to go through this fairly quickly, but we're also going to include a document you can have on the YouTube channel. Look it down in the download section so you can see these benefits because they are quite interesting. So they offer grants and scholarships to their members. Competitive scholarships provide over $2 million annual tuition for individuals and their spouses. You have to qualify, but that is an option if you're a member. Another scholarship that they offer is going to be an orphan scholarship. So if you pass away and your kids are left behind, they may have access to a scholarship for additional tuition if they want to go to college. We're also going to see a little bit later that there may just be a monthly orphan benefit based on your membership to the Fraternal Benefit Society. So it's very, very interesting what they've been doing here. Another thing that I thought was very cool is the offer was called Foresters Renew. Well, they'll pay you an extra $750 a year to eligible members who are trying to increase their learning, their skills to become more profitable. And from the insurance company's perspective, we want to encourage you to earn more money so you can come buy more life insurance. So it's kind of a give and take, and I get that one for sure. So going over these fairly quick, financial and well-being benefits, they'll allow grants that will allow you to effectively do community outreach or volunteering in your area. They provide member discounts similar to like some employers have member discount pages for different organizations, but they have thousands of these across their platform in the US and in other countries. This one I thought was really cool. They offer what's called Law Assure, which allows you to have access to creating wills and basic trusts, power of attorney, and advance directives. So that is a pretty cool perk if you have a policy with Foresters. If you didn't know that, you're welcome. Orphan benefit, I kind of mentioned this already, but they may pay an additional $900 a month to the legal guardian who's looking after an orphaned individual under the age of 18. They've also jumped on the wellness app bandwagon that many insurance companies have been jumping onto, and they are going to reward you with points such as gift that you can use to purchase gift cards, merchandise, or even donate to charities that you care about, which is a pretty unique feature. Community and volunteer activities, they do offer volunteer grants, so you can get up to $1,500 for leading volunteer activities in your community. They have additional $35 per person grants to host fun, family-oriented activities. Like, I want to know if I can host a movie night with my family and get $35 for popcorn. Like,
yeah,
that's what it sounds like, but I don't know.
The slide's opening up a lot more questions I think I got. It's really interesting.
That's right, more questions than answers. Foresters-led activities, so they do try to have a good social network among their members. They have hubs, what we'll call them, where you can connect directly with other Foresters members in the benefit society. And they also have almost like an elected official process where you can lead your chapter of the benefit society. So it's very, very unique. This is different from Mass Mutual. Let's just say it that way.
I want to know though. It's interesting. I want to know how much they actually pay out in these things. And maybe that could be for a follow-up video. But like for example, like the Forrester Moments grants up to $35 a person. How much are they spent? Like, is that something that is easy to get?
Yeah.
Is that something that's hard to get? Because if you start doing the math and you have a small policy, I think one of the considerations is like, hey, Forrester's long-term growth is not as competitive as other companies that we showed. Okay, so that's the con. And the pro is there's other things that don't necessarily show up in IRR calculator that might move the needle for you. So I think it's important for us to stay on brand to say life insurance gives you multiple benefits by your contract, or in this case, your certificate. And those all need to be factored in, and they just give you a lot more things to talk about. And I want to know, like, what are the actual likelihoods of people getting these grants each year? And it's like a sweepstakes. It's like, wow, you could have all these things, but it's like the odds of getting it are little to none. That's not what I'm saying. I'm just saying these would be some of the follow-up questions that I would love, because even like the $35 a person for Forrester's Moments, like that could be a really fun thing. And I would just love to know like how that works.
I mean, I'd go buy a $100,000 term policy for that. You know what I'm saying? You know what I'm saying? So
I'm sure there's loopholes for people like you and me, Alden. I'm sure there's I'm sure there's catches, you know? So.
Yeah, but what we'll say publicly here is if you work for Forrester's and you have an authority over this, we would love to interview you on this channel to dive deeper, because this is very, very interesting.
I think it'd
We're
be an
not
interesting
seeing this with anybody else.
Yeah. All right, let's move on, but thanks for laying that out.
Absolutely. And it's the last thing to land the plane on that slide. Remember, on average, they've given over $15 million in benefits the last several years. So somebody's qualifying, maybe not everybody, but we'll have to dive deeper in another episode. All right, as we're coming down to land the plane here, we're going to go over advantages and considerations for this carrier. Now, advantages, they've been around for 150 years, being a focus on their members. So maybe not by dividends, but they have a track record of sharing the focus of service, community engagement, volunteerism, charity that they care about, and passing that on and enabling the members to do the same. So that's very unique. I think that's worth mentioning. They're flexible and unique PUA rider. This was very interesting. That unique catch-up provision over the 10-year time frame makes it stand out. They do have anytime payments, as well as a strong minimum and maximum for larger insurance policies. And once you fund the thing, you can get access to your loans pretty quickly. So at this point, they're on track to have fast loan initiation in line with Security Mutual and Pan American that we've reviewed so far. Their Advantage Plus 2 product, when we build it for maximum cash value, actually has very strong early cash value, up to 93, 94%, which is industry leading. It's very, very strong. And then to wrap up this slide, as I mentioned a little bit already, the fraternal benefits. We just went over a lot of that, but it's very, very interesting that they make this a priority for their clients. Now, considerations. I don't think this is good or bad, but they're not a true mutual. So you decide if that's a good thing or a bad thing for your personal situation. But as a fraternal benefit society, you can't say that they don't care about the people that they serve. So I think that is something we need to definitely highlight. So another consideration, which is just batting against them at this point, is their comparative growth over time. When we look at other mutual insurance carriers in the space at similar size, or even the big four, their performance is lagging. So the question becomes, if you're batting 1,000 and you want the biggest IRR, maybe not the right carrier, but what other benefits do you get? Do you want to be a part of that type of structure that they've built? So it's something to think about. Complaint index. So I found this interesting when I started doing research, and they actually have I think they call it a newsroom bulletin that addresses this complaint index. The NAIC has an index that indicates effectively consumer satisfaction about the service provided by the insurance company. They're above average in a bad way. I mean, they have more complaints than the average, suggesting just a clear need for the agents to set clear expectations. And I think part of this could be because they're growing very fast. We've had this before. We've been doing this long enough to where we've seen some of the smaller companies that we work with, won't say them by name, but they go through growing pains for a period of time because the premiums come in, revenue starts coming in, then turns into profits, and they can hire, but that's a multi-year thing. And so that may lag behind the number of new policies they're putting in force. So had it listed on here as a consideration for you to be aware of. And then lastly, to Caleb's point, maybe it's not a con. I think catch-up provision is pretty cool, but more than 25 grand would be nice. And then that reset of every 5 to 10 years, just something to be aware of.
Yeah. My summary, just looking at the the pros and cons. I'll start with the pros. Is their, Fraternal, I think is a great place. I think it's, yeah, I don't have a problem with there being difference between Fraternal and Mutual. The fact that they've been in business for a long time is great. The fact that they can have a high early cash value is awesome. One thing that you might touch on is, and which is also going to lead into some of the considerations, is they actually have a contract that makes IMOs it easier for them to sell their policy. So for example, not to highlight any one company, but like Penn Mutual, for example, they won't sell their products through these big organizations, and they don't want like network marketing companies like having access to their product. Whereas Foresters, it's my understanding that they have contracts that are very flexible, which can be a benefit because they can work in your model. The con comes that you get a lot of people potentially having access to sell and maybe have less information. And so some of those complaints literally could just be that they're doing a business with a lot of people, and a benefit can also turn into a con. Their ability and flexibility to work could turn into a negative. That's just again, pure speculation, but that's just one of the things that I would point out from like the business aspect of this. And then I would say the two other things that are just considerations is the lagging performance. Everyone will say, well, you got to look at the guarantees. You don't buy life insurance because of quote unquote projections. But I think it's when all these carriers are pretty much the same when it comes to guarantees. You have some carriers that are just saying, you know what? We're designing a product that in some cases is going to have hundreds of thousands of dollars more. So that's where it goes. Like, I love the fact that they have fraternal benefits. I think that's great. You have to measure that. It's like, how much do you value any one benefit? You have to measure that. And so that's just something to consider. And it'll be interesting to see like how they adjust higher or lower. And then the fact that they're from Canada is not a plus in my book. It's not, I'm not, nothing against my Canadian friends. It's not a negative, but it's not like I love the fact that they're from Canada. Like, it's not like I'm going to get it. It's more of a, if I'm being honest, like I want to learn more about this, and like the fact that they don't call it a contract, they call it a certificate. I don't think anything's a problem there because they're fraternal. I just want to like understand, like, okay, worst case scenario, do I have the same rights I do from being in the States? You actually might have more rights, and I'm willing to eat my words because the government of Canada, which I'm sure I butchered that, it's probably not the government of Canada, but it's like they may have your back even more. So I just those are some of the things that as I just talk out loud, some things that I'm thinking through as we're looking at the pros and cons.
Absolutely. Well, guys, you heard it here first. When Caleb talks out loud, he wants someone to come on the channel to talk about this in more detail than we can go here today. So
yeah, I think
if you're that guy, come on.
Really great. Yeah, that'd be great.
Awesome. Well, to land, just finishing up here with the agent perspective, compensation, I think, is actually average, right? I've been saying that a lot. But one thing that I did see that they actually produce a quarterly bonus based on your production. They call it Fund Your Dreams production. I love their marketing. It's just so good.
That's great.
And their product complexity is actually quite low as well. Very similar to Pan American, but because of that 5 and 10 year PUA adjustment, I gave it a 3 not a 2. So a 3 out of 10 on the consumer complexity scale. Agent resources, it's going to say average as well. Don't work with them right now currently, so I'm just banking on the average. And then the IBC practices are understood and known by their internal reps. Everyone I've talked to so far, they understand it. They understand the concept, how to build the policies, and so they may be able to talk about it with your clients.
Yeah, and I'll just point out again that they're very much known for being able to get bigger organizations a lot of contracts, and they're very flexible with how they do overrides and all those things. And so again, that can be a plus, that can be a negative. But if you're someone that's looking to build out an organization and want to have different tiers, Foresters would be one of the only companies that you could work with that I think could customize it for you.
Yeah, excellent point, Caleb. So where does this leave us? Well, as a conclusion, the Foresters Financial Company, the order of independent order of Foresters, gosh, it's such a long name. Their product is actually quite interesting. It's the only carrier I've seen that's got that 10-year look-back ability for PUA catch-up. The product itself brings a lot of cash value to the table, and they're very unique because they're fraternal benefit structure that they have. However, we got to look at the pros and cons. As Caleb said, how much do we benefit from the benefits we have access to as clients versus the performance of the contract or certificate in this case? So weighing those pros and cons, knowing that there are more competitive marketplace options from other mutual insurance companies in the US, not in Canada, something to consider. So Joe Bishop, great guy. Product and its design and your understanding of are what matter most. The carrier choice among top mutuals is secondary. And this is the first time Joe has bit us in the butt here because it's not a mutual company. But the point stands. I think you can still have a very good contract with this particular company. Certificate.
I love it. And for those of you that have been the whole series, you'll love that inside joke that we all have here at the end. If we want to tee up the last slide, I'll just say, if you have a policy that you want us to review, we'd love to review it, whether it's Foresters, whether it's not a Foresters policy. I think if there's something that we've established in this whole series, we want to be a leader when it comes to education, when it comes to exposure, when it comes to just helping you better understand how these companies work. And we would love to help you, whether you want us to set up a policy for yourself or talk about, does a policy make sense, or review a policy that you currently have. And a way that you can help us grow, especially on YouTube, is by subscribing, liking, commenting. If you're already subscribed, hitting that notification bell that actually tells YouTube, hey, I really, really appreciate what this channel is all about. I want to be notified. But then again, YouTube's algorithm's a lot more complicated than how dividends are projected and all. And all of that just goes to show, hey, these people are doing some great work. And so that's how you can help us if you found this information valuable.
Absolutely. Well, thank you, Caleb. It's been great. This may be the last video, or we may have one more. So we'll have to see. See you guys later.